Good morning, everyone, and welcome to the second day of the 53rd FINEX Annual Conference. The theme of the third session is the regional and global cooperation to achieve capital growth. May I now call on our MC for today. He is the President and CEO of DES Financing Corporation, Mr. Carlo Enrico Lazatin.
Good morning, fellow FINEX members and guests. Welcome to the third session of the 53rd Annual FINEX Week Conference. The theme of this year's conference is Inclusive Disruption, Achieving a Sustainable Future in the New Frontier. This year, we will be rolling out a series of webinars involving prestigious speakers discussing thought-provoking topics. Our third session this morning will focus on the regional and global cooperation to achieve capital growth. Warburg Pincus is one of the leading equity firms that provide funds for companies and investors around the world, helping companies to expand businesses for profit. Hence, we invited a speaker who is a driving force in making those transactions possible. Mr. Agarwal joined Warburg Pincus in 2009 and is based in Singapore. He relocated from New York in 2016 to focus on the firm's investment activities in Asia. Prior to joining Warburg Pincus, Mr. Agarwal joined at McKinsey & Company in New Jersey and New Delhi, and also with Temasek Holdings in Mumbai. Mr. Agarwal is currently a director of Circles.life, Converge ICT, MomoPay, and Techcom Bank, and previously also served on the boards of several companies, including CleanMax Enviro Solutions, AAG Energy, Competitive Power Ventures, Mosaic Inc., Rimrock, RSEG Inc., and Trident. Mr. Agarwal holds a BTech in Electrical Engineering and an MS in Microelectronics from the Indian Institute of Technology in Bombay. He holds an MBA from Harvard Business School. Ladies and gentlemen, Mr. Saurabh Agarwal.
Good morning, everyone. Thank you for the kind introduction, and thanks for the opportunity to speak at this event. I'd like to use this opportunity to provide a brief introduction to Warburg Pincus, share our views on the Philippines, especially in this tough COVID environment, and offer some perspectives on our investment focus going forward. By way of quick introduction to the firm, Warburg Pincus is one of the largest and oldest global private equity firms in the world. We have 55 years of investing experience, during which we have invested nearly $100 billion in about 1,000 companies across multiple sectors and geographies. Today, we have over $65 billion of equity assets under management and over $20 billion in new capital available to invest in new opportunities. Importantly, we are a pioneer in emerging Asia and have been actively investing across the continent for over 25 years. As with Southeast Asia, we've been investing in the region for the better part of the last decade, and we are now one of the largest and most active private equity firms in Southeast Asia. To date, we have invested or committed about $3 billion into 15 companies across the Philippines, Vietnam, Indonesia, and Singapore. In the Philippines, we are the largest institutional investor in Converge, the largest and fastest growing fiber broadband company in the country, and we are actively looking to invest much more in the country going forward. To touch upon our investment philosophy, it's quite simple and time-tested. We partner with best-in-class management teams and provide them with long-term patient capital to build, grow, or transform their businesses across cycles. As we do that, we work closely with our portfolio companies and help them achieve their growth aspirations while adding value through industry, strategy, and capital markets expertise. We are 100% committed to the long-term success of our partners, and more importantly, the success of the people in the countries we operate. As we approach our partnerships, our focus is on creating fundamental value through underlying business growth, as opposed to timing the market or being cute with financial engineering. To achieve this growth, we support our portfolio companies by bringing deep domain expertise, access to extensive global network of experts, and often very relevant learnings from countries like China and India, which have gone through similar phases of growth as some of the countries are experiencing today in Southeast Asia. In the Philippines, we are proud to have partnered with Converge, working very closely with the founders, Dennis and Grace, over the past 3 years to help transform and grow their business. The Warburg Pincus team has been working along neck to neck, side by side with the company to help with the implementation of multiple key initiatives. Some of these include building out the C-suite and instituting world-class governance structures and systems, helping raise $600 million of long-term debt at attractive rates to fund the company's CapEx program, facilitating the company's IT transformation and business optimization efforts, and helping the company secure proprietary access to international backbone capacity. Importantly, we are proud to have helped execute the company's IPO on the Philippine Stock Exchange. The landmark transaction represented the largest ever IPO in the Philippines at the time of listing, the largest ever telecom IPO in Southeast Asia, and the largest fixed broadband offering globally over the last 5 years. On the back of our investment in Converge, the Philippines is now a high priority market for Warburg Pincus. We believe the country has some very compelling macro and demographic fundamentals. It is one of the fastest and most consistently growing economies in Asia. It is increasingly becoming a digital economy, and its consumption rate of 70% is one of the highest in the world. Its large, young, and increasingly affluent population will drive significant growth-forward consumption growth. And importantly, the regulatory regime is reform-minded, the administration is pro-growth and pro-business, and the business community is generally supportive of new entrants and foreign investment. This is obviously a very difficult time for the country. And despite all the stimulus efforts, the economy has contracted last year for the very first time in a very long time. It's not much different from what's happened in the rest of the world. While the outlook may appear grim to many, we strongly believe that the pandemic will be more of a short-term drag and things will improve meaningfully once vaccines are deployed and scaled. In our view, the long-term fundamentals of the Philippines remain largely intact, and we expect the Philippines to significantly rebound and resume its strong growth path of over 5%, which would continue to set it apart amongst other economies in a relatively slow growth world. As we think about investing in the Philippines, how much has our investment approach changed during the pandemic? The honest answer to that is not much. We invest across market cycles and do not attempt to time the market. If anything, we tend to double down during periods of market dislocations. And as you can see from the chart, we significantly increased our investment activity during the past 3 dislocations. It goes back to our core investment philosophy, partnering with best-in-class management teams and providing them long-term patient capital across cycles, an approach that has allowed our portfolio companies to remain well-capitalized through the pandemic and in fact lean forward to aggressively scale up and even pursue M&A opportunistically. While COVID hasn't altered our fundamental investment philosophy, we do believe it has created some unique investment opportunities. Take financial services, for example. The Philippines is significantly underpenetrated across all major financial products. 70% of the population is underbanked. Only a few have access to formal loans, and very few have access to credit cards or insurance. In this backdrop, we're seeing an accelerated adoption of fintech products And there's a strong opportunity in the new economy financial services with the rise of e-wallets, digital banks, digital wealth management, and insurtech. Similar trends can be seen in the tech and consumer space. The digital economy is beginning to reach an inflection point across emerging Southeast Asia, including the Philippines, as customers shift their consumption towards online channels. We expect that the Southeast Asia digital economy would represent a total addressable market of 300 billion over the next 4 to 5 years. This explosive growth has led to significant opportunities within e-commerce, tech-enabled logistics, data infrastructure providers, cloud-based solutions, etc. While we continue to be extremely bullish on the Philippines, we're hoping for the travel restrictions to lift up so we can spend more time with our existing and prospective partners. Traveling and meeting with entrepreneurs and management teams are essential to adding value and building long-lasting relationships. In the meanwhile, we continue to remain active in this new normal over Zoom and are optimistic that our investment pace in the Philippines will continue to ramp up over time. Thank you.
Thank you, Mr. Agarwal. At this point, I would like to introduce our panelists. Each of them will have 5 to 7 minutes to present their reaction and insights about the topic, which will be followed by an open forum. Allow me to introduce them in order of presentation. Our first panelist is Mr. Rafael Consing Jr. Rafael, or Joel, is the SVP and Chief Financial and Compliance Officer at the International Container Terminal Services, Inc., or the ICTSI. He is a member of the ICTSI Executive Committee and a board member of ICTSI's various international and domestic subsidiaries. He was also recently appointed to the board of directors and the ExCom of Manila Water. He is also a volunteer in the ICTSI Foundation, where he is primarily assigned to the Moderna vaccination program. Our second panelist is Mr. Eric Francia. Eric is the President and Chief Executive Officer of AC Energy Corporation. Under his leadership, Ayala established its energy platform from a standing start in 2011 to become one of the largest renewable energy platforms in Southeast Asia, with over 2,000 megawatts of attributable renewable capacity. Eric is also a managing director and a member of the management committee of the Ayala Corporation since 2009, and was appointed as chairman of Ayala's investment committee in 2021. He's also a director of various Ayala Group companies, including Eric earned a master's degree in management studies at the University of Cambridge in England, graduating with first-class honors. He received his undergraduate degree in humanities and political economy from the University of Asia and Pacific, graduating magna cum laude. To facilitate the open forum, may I also introduce Mr. Ricardo V. Francisco, head positions in BDO. He is president of BDO Capital and Investment Corporation and chairman of Averon Holdings Corporation. He sits on several boards, such as the Development Center for Finance, CIBI Foundation, Shareholders Association of the Philippines, SharePhil, International School of Manila, UP College of Business Alumni Association, and member of the Makati Business Club, and a very strong contender of the Polo Triathlon team. He is the former chairman of BDO Nomura Securities, Inc., and chairman of the IFA, or the International Association of Financial Executives Institute, and he was the co-chairman of the Capital Market Development Council of the Philippines. He was also vice chairman of the Integrity Initiative and has been the president of the Management Association of the Philippines, FINEX Institute, Wharton Pen Club, Makati Sports Club, Federation of Valle Verde Inc., and BDO Securities Corporation. Mr. Francisco has worked with other financial institutions in New York and Hong Kong, and he holds an MBA from the Wharton School of Business Administration from the University of the Philippines. He is a recipient of the Financial Management Excellence from the University of the Philippines and the Distinguished Alumnus Award from the UP College of Business Administration. He was honored by Biz News Asia as one of the nation builders and was an Asia Leaders Awards Mentor of the Year finalist. Ed, the floor is yours.
Thank you, Carlo. Good morning, everybody. Thank you to FINEX for inviting this August panel. I guess I apologize for that long intro, but my value add really here is that I've had the luxury of working with Sir Rob, with Joel and Eric on many transactions and deals. At least it's regarding capital. In fact, I was in the landmark IPO that Sir Rob was discussing. We were one of the domestic co-leads. So we had a big role also in helping Sir Rob even with the financing. And same with Joel and Eric in their sustainable and other transactions. But anyway, this morning, the audience, feel free just to send in your questions, and then the secretariat will send the questions to us. But we have roughly an hour, because what I just wanted to let the audience know is that 11 o'clock, Sir Rob will have to leave us also for yet another appointment. He can't leave. But should there be more questions, I have requested Joel and Eric to stay to answer some of your questions, which I'm sure there'll be many because we wanted to learn from them. So maybe with that, I would like to ask now maybe Joel, you first, and then I'll ask Eric to give your actions, and then we'll have a Q&A. Joel, the floor is yours.
Thank you very much, Ed, and thank you also for the introduction, Carlo. So and greetings to all fellow FINEX and guests, FINEX members and guests. It's great to see you all here, now safe and well. You know, the talks since yesterday have been very insightful, and we really hope to add new dimensions to this discussion. So, you know, my views will be from the perspective of capital formation, meaning FDI is meant to serve the export market rather than the flow of liquidity, i.e. stock market, credit, IR, and FX arbitration. I mean, arbitrageurs. I think personally, that's the easy part. So, you know, let's go through a few stats. Exports, if you take a look at it from a continental lens, the Philippines partners, export partners, roughly 70% comes from Asia, about 16% comes from North America, 11% in Europe, Australia, 0.7%, South America, 0.6%, and Africa, 0.2%. So it tells you that there is absolute scope to be able to expand that market. Now, from the perspective of FDIs, you know, Vietnam and Indonesia, it's all over the place, are leading the way, and we, a country, the Philippines, are actually punching way below our weight. To put that in perspective, between 2020 and 2019, our FDIs came down from 8.7 billion to about 6.5, but Vietnam went down only from about 16.1 to 15.8 billion, and Indonesia from 22.8 to about 18.8. So hence, we have got almost the same demographics, and yet we are punching below our weight. So there is really scope for the Philippines to pursue a more aggressive and perhaps more creative diplomatic trade policy. So in the same manner that China sent out its diplomats to pursue a wolf warrior diplomacy to meet its gains, we can send ours on an economic charm offensive. Now, joining global and economic trade blocs may or may not give us the leg up against competition. So I was hoping that Sarab would have covered this earlier, but let me mention a few. For example, RCEP, okay, so the Regional Comprehensive Economic Partnership, for example, has given us a few advantages, only a few advantages. No, pardon me, let me rephrase that. Has given us no advantage over our neighbors because all 10 members of the ASEAN are part of it. So yes, trade will rise under RCEP, but in absolute terms, rather than relative to our neighbors. Okay, now, With regard to the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, or the CPTPP, the membership is more selective. So therefore, countries which are invited to join would really achieve what we would refer to as a trade diversion effect. So let's talk about the region. Let's talk about our neighbors. Malaysia is on the fence and its interest to join the CPTPP. Thailand is not a member. Indonesia is also not a member. So if the Philippines does indeed gain membership in CPTPP, we will gain access to new markets for our products and potentially new investors for FDIs. But then again, we have to ask ourselves, why the dismal performance, right? So our dismal performance in attracting FDIs is not because of any lack of engagement in the global marketplace, frankly. If you want to attract real long-term capital formation, we need to look inward, not outwards. Economic and trade diplomacy must be supported by domestic policy and infrastructure. You've seen the list before, so I'm not going to go through. I'm not going to go run through that list. But I would, however, recommend 3 specific recommendations. 1, develop and promote more free trade zones. You've got this new law or a judgment in the Supreme Court, which would give LGUs access to a higher level of capital or bigger share of national earnings beginning next year and onwards. Work with LGUs in building agro-industrial estates and link the trade and investor roadshows around these. And maybe 3rd, just linking it also to our experience in ICTSI, wherein we are making investments through the Netherlands and similarly through Singapore, primarily because of the bilateral trade and investment protection treaties that they've signed with everyone else. And that is what I would recommend. So just to summarize, really from a capital formation, my point is very simple. Economic diplomacy, we must pursue aggressively, but it must be supported by strong domestic policies. You add those 2, then what you have is capital formation. That's all I have, Ed. Over to you.
Thank you, Joel. Very great. At least you were talking already about, I guess, what the government can do, and let's get back to that later. Maybe I'll ask Eric. Maybe can I ask also for your thoughts also on Saurabh's presentation and thoughts you want to share?
Thanks, Ed. Yes, and good morning to everyone. Good to be part of this morning's exciting discussion. First, allow me to briefly react to Saurabh's presentation. I'm very delighted to see the positive experience and outlook of Warburg Pincus in the Philippines, and congratulations on the success of the Converge investment, Saurabh. I'm fully aligned with 3 themes that were mentioned, particularly financial services. Underlying that, arguably, is fintech. There's also the TMT or the digital space, as well as the consumer theme, especially in light of the impending recovery amidst this pandemic, which is a matter of time. This is also aligned from an Ayala Corp standpoint. The way we view this, we have a strong consumer focus as well, with Ayala Land and BPI expected to lead the recovery. And in the case of Globe, the digitalization theme is well underpinned. One thing that was not mentioned by Saurabh, for understandable reasons, perhaps in the context of Philippines, is the decarbonization. And that's also one of the focus areas of the Ayala Group, and perhaps one of the emerging themes. Now, I would understand why that wasn't on the list, because arguably of the lack of apparent scale in the context of the Philippines. But I truly believe that will change over the next decade or so, number 1. And number 2, that there are regional opportunities. I think later on, Ed will talk about the globalization or regionalization, at least, of various Philippine companies. And again, we may not have the competitive advantage in many sectors, but for a few, we've got the examples of ICTSI and AC Energy. Hopefully, Manila Water will also be going down that track with its new sponsorship now. But definitely, renewable energy and in the space of energy transition is one strong theme. It's a very exciting time to be in the global energy sector, whose growth relies a lot on the global financial markets. And in case you haven't noticed, which I doubt, sustainability has become a very powerful force in the energy and financial markets. We've seen a strong inflection point around 5 years ago, around the time when the UN established the Sustainability Development Goals, the UN SDG. This was also around the time when renewable technology was approaching grid parity, competing with coal and gas, and the energy transition started to gather steam and has now become the new imperative. Over the past 5 years, we've seen green bond annual issuances also rise more than 10 times, from 50 billion to 500 billion US dollars annually. And the ESG ETFs, or the exchange traded funds, also grow spectacularly, over 50% per annum, to well over $500 billion of assets under management globally. And as many of you know, Ayala has been at the forefront of sustainable investing, being a UN SDG pioneer. The energy platform, ASEN, which I run, is an early mover and leader in the energy transition. In 2016, we made a strategic pivot from thermal to renewables and expanded beyond the Philippine shores. In 2018, when the company was at 250 megawatts of renewables, AC Energy set an ambitious goal of reaching 5,000 megawatts of renewables by 2025. It sounded aspirational back then, growing 20 times, but now we're currently at 2,100 megawatts. It seems that that goal is around the corner and needs to be stretched over time. In 2019, the AC Energy Group also divested major coal assets and committed to transition to a low carbon portfolio by reinvesting these proceeds. And we also reinvesting into renewable energy, and we also committed to divest the remaining coal assets before 2030. Today, as I mentioned, ASEN has 2,100 megawatts of renewables capacity in the Philippines, Indonesia, Vietnam, Australia, and India. The company also has 12,000 megawatts of renewables in its pipeline across the region. We shored up our balance sheet. We have over $1 billion of cash, with a low gearing ratio of less than 50% debt to equity. So yes, Ed, you can provide us more funding support. ASEN has been very busy strengthening its balance sheet this year. We have raised close to $1 billion from a series of capital raising, a 12 billion peso private placement with GIC, Singapore's sovereign wealth fund, the 5 billion peso stock rights offering last January, and the 13 billion peso follow-on offering last May, and most recently a $400 million US dollar fixed for life green bond, which was 5 times oversubscribed. This was launched in September. And yes, it's not even the end of the year yet. It's been quite busy. And with this strong balance sheet, the robust pipeline, excellent partnerships across the region, and an agile team, ASEN is poised to play a leading role in this energy transition and help drive the green-led recovery. So happy to discuss details and nuances of this interplay between the energy and financial markets with the rest of the panel. Thank you.
Thank you, Eric. Thank you, Eric. Joel, for your reactions. Maybe I'll start the ball already. Let's do the Q&A, and then we'll ask the audience to send questions. I have a list of questions here anyway, and if you'll allow me, let me ask some of them. I'll start with Eric. Eric, anyway, thank you for sharing, the path of the renewable, and I applaud you and PG and your announcements. I guess aside from the challenges, I guess in the rewards, how has it affected your investor base? I guess from a regional perspective, is there a bigger portion of international, or is it still domestic? Maybe you can share that with us.
Yeah, no, definitely. It was a conscious effort for us to broaden and diversify our investor base, both on the equity capital markets and the debt capital markets. On the equity side, as you know, when we acquired FINMA Energy, which was the listed platform, and decided to transform that into ASEN, the more than 98% of the investor base was really local retail. So first of all, the first insight I'd like to share is, which is not obvious among the big corporates, is retail investors are quite important. right? We want to educate them with our plans. We want to communicate to them so that our IR is not only focused on institutional investors, we also cater to the retail investors. It's important to educate them. As we know, especially during this pandemic, the rise of the retail investors was just enormous, right? They now account, I believe, close to 70% of the local equity markets. So that's number one. Number two, having said that, we want to be able to diversify still and bring the long-term institutional investors. And that was the benefit of having the follow-on offering. We targeted institutional funds, mostly foreign, but also the local institutionals. So that was, it was a limited offering. It was only about 2 billion shares out of pro forma close to 40 or 39 billion shares. So it represented only less than 5% of our total capital base. But the advantage of this was we were able to really select the strong long-term investors as a matter of course. Now, the other thing is size begets size, right? And as you've seen, we thankfully made it to the Philippine Stock Exchange Index, the PSEI, last August, joining Joel in that elite club. And we're hopeful that MSCI would be next. The main index would be something that companies like us would be aspiring for. So again, it brings in index funds as well to hold your equities long term. So there's very robust investor base and good names out there. The other type of investors that I think remains to be unlocked, we already have some of that investor base, is the ESG investors. We still have about 20% of our portfolio in thermal assets. I think that will go down over time to an insignificant number as we ramp up our renewables and divest our coal. I think once that happens, then that will unlock the potential to bring in the ESG investors. Not everyone, there's different types of ESG investors. Those who are really dark green, who want pure renewables, but on the other side of the spectrum are ESG investors who would be more flexible, pragmatic, and so forth. So it would be good to cater to a broader set of those ESG investors as well. Of course, on the bond market, we also cater to the mainstream market, but we're seeing more and more presence from ESG-oriented investors, and that's why the green bond did so well. Stark difference between the last one that we did versus 2.5 years ago. This time it was 5 times oversubscribed. So you can see the strong momentum among the global ESG investors. And also, of course, the name being better established and so forth helps a lot as well. So yeah, Ed, it is a fascinating market with a lot of excitement on the ESG investment space. And we can feel the tremendous support for these sustainable investments.
Nice. So we can see the journey as you go more green or greener, as he said. Anyway, maybe Joel, I ask you naman a shift naman to Joel, because I guess when we always think of your group, Joel, you're like a Viking for the Philippines, because you invest in countries that others would not even dare visit. Maybe can you share us your experience, and maybe the thought process of why you and Mr. Razon would invest in Iraq and other countries when we ourselves would not even want to get a visa to go there?
Great question, Ed. So just to give everyone perhaps some views to where we are. Let me just share my slide. Okay, so there you go. Right. So many of these countries, frankly, I actually just heard of them when I joined about 15 years ago.
Okay.
So if you step back, the best way to characterize ICTSI is we own and run a portfolio of origin and destination ports. Okay. So and really, once you go through the potential returns of that particular space, at the beginning, when you're building the portfolio, you almost always ended up in emerging market economies. Right. So hence, when we talk about what you've described earlier, i.e. getting into Iraq, Congo, et al., and certain of these countries in front of you, we're really talking about political risk, right? So hence, and if you look back, political risk is innate in the portfolio. And hence, as long as they're not occurring all at the same time, then you are really diversifying your political risk. In managing your political risk, we look at it in 5 different stages, right? So hence, it starts with a bid. Typically, when you put a bid, unless the rules are very specific that you actually have to put in a fixed price for a lease, for example, we normally put in a big leaning towards variable or paying royalties to government, because you're going to be there for the next 25 years. And hence, while your volume grows over the next 25 years, you are therefore friendly to all the regimes that you are basically serving underneath. So that's the first. Second is where you will be creating your company from. So in our case, I made mention earlier about 2 areas from which we undertake our investments. One would be the Netherlands. Intuitively, about 65% of the portfolio is invested to the Netherlands. Currently focused on Latin America, all parts of Europe, and Africa are done through the Netherlands. Partly also in Singapore and in Dubai. Now, Dubai is a very, very small regional office, but it's really, the vehicles are really Singapore and the Netherlands. And what drove us there? Taxes, obviously, having a tax treaty with the Philippines obviously helps. But really, if you are entering these countries, equally important would be the bilateral investment protection treaties that both these countries have signed with individual countries. And the bilateral investment protection treaty is really all about these countries protecting the investments of their national champions. So hence, from the perspective of the Netherlands, they are protecting the investment of Shell, ING Bank, across all these emerging markets that they entered. And same with Singapore in terms of the investments of Temasek et al., right? If I remember correctly, the last time I looked at it, there was roughly about 128 countries with whom the Netherlands had signed the BITPS with. And if I remember correctly as well, I believe Singapore was about 84, 85, right? So hence, making that investment at the onset through these vehicles would be the next step. Third is your capital structure. So what we normally do is we put in the minimum equity required just for you to be able to meet what you call thin capitalization rules. Okay. That would then allow you to take tax deductibility on your interest expense, below which you would not be able to. Right? So hence, you don't need for retained earnings to start accreting before you can start repatriating capital. Once you become EBITDA accretive, you can start returning cash by way of either interest, or if you want to return back to principal, depends really on the capital structure and your P&L at that point in time. So you've got your capital structure, and then fourth would be the commitments that you have. Well, it's part of the second one, with commitments that you have in your concession agreement, i.e., we normally under promise and obviously over deliver over time. And in addition to capital structure, you also have to take a look at the domestic markets, because obviously you would not fund it all. Once the business becomes self-funding, what we do is we would normally transfer the risk out of the parent down to the subsidiary, down to the lenders of that particular economy. So we transfer to local banks. We also take a look at the FX environment. So obviously, when we enter into countries, I mean, the reality is we operate in 22 countries. We trade in about 16 currencies, and let me show you what these are. I mean, just to give you an idea as to how we manage foreign currency risk. So what we do is we don't enter into derivatives, albeit we've got board approval to do so. I don't want to put derivatives in the balance sheet as much as possible. Rather, over the past 12 years, we have been negotiating our contracts directly in order that we are getting our flows naturally. So on the left-hand side of this table, you will see the list of our subsidiaries and the revenue and expense flows per currency. So for example, MICT, that's Manila, 40% of our revenues in Manila is denominated in US dollars. That represents the relationship between the ship and the shore, right? So our relationship with international shipping lines. And 60% of our revenues are denominated in Philippine pesos. That now represents the movement between the yard all the way to the gate for the account of the importer and the exporter. On the expense side, only 7% of our costs in US dollars and all the rest are in local currency, and so on and so forth. On the right-hand side, that's our consolidated exposure. So about 50% of our revenues are in dollars, but only 32% of our costs is in dollars, and the rest are in different currencies. So hence, I've also put in a KPI to our cash and risk manager, who is now our recently promoted treasurer, wherein we cannot have an FX impact greater than 0.25 basis points of EBITDA margin. So we link our KPIs to the natural hedge that we've tried to put in place. Finally, you have to really focus on your strengths. So in our case, not all opportunities need to be taken. So there are, for example, opportunities that are presented to us onshore domestically, which we could actually try to, perhaps in the short term, we would be able to achieve quite strong returns, but in the long term, you might be competing with your customers, for example, right? So hence, all of those are percolated into a single political risk management. So Ed.
Wow, very interesting. So those are the, but then Joel, how easy is it for you to leave a country if, let's say, it's turning against you? Though? What is the process there?
So, we're there for 25 years, right? So we're not a manufacturing firm. Unlike other Philippine companies, perhaps to go abroad, they might be exporting their facilities or their products abroad. This is different. Port industry is a very local business. We run our companies federally, okay? However, all departments have to work within a set of KPIs that the global corporate team would then manage very deeply and very intensely, I would say.
Right. Thank you, Joel. Well, anyway, we learned a lot. I guess the audience learned a lot from Joel and how they invest from point 1 to point 4 and point 5.
Oh, sorry, Ed, pardon me. Just one last point before I leave that point.
What was the last?
Similarly, when you look at investments, you have to look at it as on a risk-adjusted basis, right? So hence, the equity returns that we look for in Africa is very different from the kind of equity returns that we look for in Latin America.
How do you adjust for that? The risk-adjusted returns, country risk and everything. How do you price them?
I won't tell you what the nominal rates are because that's
okay.
the secret sauce, right? But we do have a black box that was built over the past 12 years. It takes off from some of the black box that are out there in terms of our discount rates. But the reality, those discount rates are nominal. They are not real. They are purely from modeling perspective. The value of your share of your shares is really driven by the cash flow, not necessarily immediately at the speed at which it comes, but the fact that it simply generates it. So hence, you really take a look at IRR from very different levels. So hence, don't get confused as to what kind of returns and where is it being taken, right? So quite a lengthy discussion internally, actually, one has to go through.
Yeah, sure. So I'm sure it's a very involved discussion when you present to your board and your shareholders. Thank you, Joel. With that, I guess I want to move now. Let's go. So at least we learned from Eric from his capital raising experience and shifting out of fossil into this new realm, and then the kind of investors he's getting. And then Joel explained to us how he, I guess, invests in other countries. Now let's ask Saurabh some questions. Saurabh, maybe you can share with us, I guess, how, when you talked about the three areas, right? I guess tech, consumer, and the others. But I may be going back to Converge first. How challenging was it to convince Dennis and Grace Uy let you guys in because I guess they're very different, right? Their mindset, and then suddenly they have this international, you know, guys who know, you know what they're doing, but then suddenly, you know, they have somebody whispering behind them or helping them strengthen their bench strength. Maybe you can share some of that with us, the audience.
Sure, Ed. Look, I mean, that's a good question. And I'd say it's never easy to come into a new country and as an outsider and then convince the founders to partner with you. So in that respect, you know, having struck the relationship and helping sort of, you know, grow the company has been quite a positive experience. Although I would say, look, I think contrary to what many people may think, our relationship with Dennis and Grace was built actually over a period of time before we executed the investment. I remember, you know, we had identified Philippines as a priority market for Warburg back in 2016, 2017. In the peak of 2017, you know, I was taking, you know, prospecting trips, business development trips to Manila at least twice a month, just to sort of, you know, get to know the people, get to know the country, introduce people to the firm and the kind of things we had done. So it took a while of getting to know, you know, the sectors in the country before we actually kind of executed the investment. On one of these trips, you know, I'd met with Dennis and Grace. Converge was actually quite small at the time. I remember, you know, the business today is kind of tracking with 260 million, 270 million EBITDA based on announced kind of numbers. But at the time, we were talking at kind of 25 million EBITDA, a customer base that's kind of, you know, less than 100,000. Wow. So yeah, it was actually very, very small at the time. And, you know, I would say despite the size of the company, I was actually quite impressed with Dennis and Grace. You know, they had the vision. They had a very strong operations focus. And more importantly, they had a very strong execution mindset, which is what you need for a business like this, right? It's all about executing and rolling out ports in the right sort of places and so on and so forth. So that was quite impressive. I also remember, you know, Dennis at the time and even today, you know, he could see this huge, what he used to call kind of a blue ocean market opportunity that most others were not seeing at the time. We had invested in similar businesses globally. We'd invested in Europe, we'd invested in Brazil, and we had identified fiber broadband as one of, you know, the core value creating sort of subsectors within telco. And, you know, our vision was sort of quite aligned with Dennis's vision at the outset, which just allowed us to build sort of great alignment early on. The other thing I would say is, look, I think Dennis and Grace at the time were looking for a partner that could just, you know, that was not only there to help with capital, but also to add value to the business, especially in areas that weren't core to their expertise, right? You know, operations, execution is Dennis's core, and nobody, in my view, can do it better than he does. But the great thing is, you know, Dennis and Grace, they were both sort of good listeners and open to having someone come in and really be helpful on the other sides of the business, right? In that respect, you know, we'd had a great track record, you know, both in Southeast Asia and similar businesses, like I said, in other countries, where we had brought in kind of the best of our resources, and kind of taken multiple businesses from, you know, when they're bootstrapped to as they go through kind of the steep portion of the growth curve and ultimately to IPO, which actually sat very well with Dennis and Grace. So all of those conversations over a long period of time of our, you know, courtship period where both sides got to know each other led to this partnership. It wasn't created in a couple of days or a couple of weeks.
Ah, great. But anyway, that shows also your perseverance, and now all the rewards are coming up. And in fact, I think one of the things mentioned also by Eric and even alluded to by Eric and impacting Joel and you is that I guess getting involved in getting your stocks in the indices really help a lot. So Eric, so Rob, I'm looking to the November. November is the next, I guess the next date important, right, for the MSCI. So Rob, maybe I ask you. I guess in your chart you talked about tech and consumer, and then you also said that you had a slide there about 20% roughly average growth in revenues and EBITDA. What is the minimum investment for those interested in the audience for you to look into them?
Look, I always get this question asked, Ed, and I would say, for investors of our size and scale, one of the key consideration is a return on time, right? So for us, while obviously we want to have our fund sizes are at this point, as I shared in my presentation, we have $20 billion of dry powder across funds. We are just going to be launching our next fund, which would be a $15 billion fund. And, our team has actually not expanded as much, which means that we are writing larger check sizes behind portfolio companies. On an average, we have about 15 portfolio companies in Southeast Asia with about $3 billion committed. That gives you a sense of our average check size. But, I would say I never tell people that we can only do a certain small check size, because look, if the opportunity is a certain large check size, and if the opportunity is very exciting, then it's the dollars out that matters more than the dollars in. So I would say, having said that, probably anything less than 100, 125 tends to get on the smaller side for us. But there are ways, if things are, interesting, where, perhaps you could start with a little smaller, but over time build a larger position. We could sort of get our head around it. But going back to what I said on return on time, I think that becomes kind of a bottleneck for us, because look, we're not going to invest in businesses just to provide capital. We are going to jump in and we're going to ask our partners on where they need help. And in areas they need help, we'll go above and beyond. And so long as we have the ability within our team and our bandwidth to do that, we'll continue to charge forward. At any point, if we felt like, oh, this is just a bet and we're just trading in and out, that's not our style. That's not how we built our business. So I would say ultimately it comes to making a call on return on time, more importantly than necessarily the size of the check.
Thank you, Saurabh. No, anyway, from my experience dealing with you and Grace and Dennis, we really see that. We see how involved you are in. So you're not. Initially, we thought, okay, you'll just be at the board, just get reports once a month. But we see how active you are, and with Matthias there and everybody. I guess for the audience, they are a great team to work with, because they're very involved, very supportive at the strategy level, and then they really help and bring value in. Maybe I can also ask Eric, Joel, is it the same with you also? Because I guess for the three of you are really big boys already, right? So I guess for AC or for ASEN and for ICTSI, what is the project size to make it interesting also for you to mobilize and to look into a deal, or look into a project? Eric, maybe I start with you.
Sure, Ed. Now, wearing my Ayala Corp hat, no, it really does vary widely, perhaps much broader than someone like Saurabh. No, we do have corporate venture capital as well. As you know, we've set up a $200 million fund under active fund, the Ayala Corp sponsored fund. No? So this fund can do bite-sized investments in a couple of $1 million size. That's really more of a pathfinder to make sure that we are out there understanding the emerging trends and so forth, stuff that could be synergistic with our core businesses and so forth. Then you've got the emerging businesses like healthcare and logistics, where again, it's the investment over a time period. It doesn't have to be one time, big time, as long as we have a path to scalability. Energy, as a prime example, 10 years ago when we started with AC Energy, we were trying to look at significant deals that will move the needle. We were looking at $400-500 million type deals, or even $200 million. But we had like 3 or 4 false starts until I said, you know what, let's do it the old-fashioned way. Let's do greenfield. Let's start small. Our first investment was a 12 million. You were involved.
Yes. Bangi Bay.
Northfield. Yeah. It was a 12 million, as you recall, $12 million modest investment, right? And then we just added, SL Tech after that. So the 12 became 50 or 60. until we put in 160 for Mariveles. So until we were writing much bigger checks at 400 billion. But in total, we deployed $1 billion of capital in our energy platform. So it could be something that's progressive. The important thing is to build the platform to get to a certain scale. I don't know, Joe. Yeah.
Maybe I'll just add to that. I think Eric's,
Yes,
I think Eric touched upon something that I kind of mentioned very briefly, so it may have gotten lost. I think our approach, when I talked about kind of building over time, is also quite similar. Whether when we're looking at investments where there's only a one-time opportunity, then the sizing considerations and return on time considerations come more into play. But things that are earlier stage, and we are a bit of an odd duck relative to most other private equity firms, that we are able to come in much earlier into companies with the growth mindset we'd had, kind of having invested in Asia for 30 years. In those situations, we can see a line of sight of, kind of supporting companies over time. And there kind of the sizing considerations become a little easier as you see it as an aggregate sort of check size as opposed to upfront. And even then there is, given it has to make sense in the broader scheme of things of our funds, but much easier discussions in that respect.
So you see, you also have the scalability, so the line of sight.
Correct.
Right. And I guess before I pass to Joel, I guess for the audience, you see what I like about Eric's management styles. They had a strategy. They wanted to go for the big ticket items, but then it was hard to get into these deals. And then so he pivoted, and then he got these small ones to get the ball rolling, and then look where they are now. So I applaud you for that, Eric. Joel, maybe ask you also what moves the needle for ICPSI for your bids and for your transactions? Oh, there you are. Great.
So I like showing slides. So yeah. we work with a company called Drury Maritime Research.
That's an external company.
Correct. They're based out of the UK. And what we do is every 4 or 5 years, we ask them to map out this universe that we've asked them to do. So we've asked them to look at the universe of ports across the globe. There are about 1,312. We've then identified our sweet spot from an M&A perspective. We've identified that as early as about 15 years ago to have been in the $500,000 a year range and below. So we've gotten that universe. We've asked them to slice them in different sizes and put there the number of terminals that there are per
and this is global already, Joel, right?
Yeah. And then, they don't privatize ports. They privatize terminals. So hence the focus must be on terminals. And then from there, on the fourth from the left, I've asked them to identify how many are still in in government hands, because that's our privatization pipeline.
Okay.
And it tells you that over in the last 4 years, we have about 405 state-run economies or ports that we could actually go for over a period of time. Right now, that size can go as low as 50,000. We can start from zero. Our latest investment, for example, is in Nigeria. Nigeria, we only put in about $12 million US. We just bought equipment, and so far they've been accretive actually within 4 months of operation. Because at that point in time, depending on your investment, because if you're only investing in equipment, then your depreciation charges are very low, so it gets the accretion pretty fast. The other way that I would respond to that question would be by looking at this slide. So it's going back to 2007 because that's when I started. So we charted it in 2007. When I joined, there were about 12 terminals. Over a period of time, because of the growth that Mr. Razon had laid out for me on my first month at ICTSI as treasurer, I knew.
I remember from HSBC, you were already You're already promoted regionally, and then I was so shocked you were going to work for a local conglomerate, and you were being shy about saying it was Mr. Razon then.
I've given this company the most productive years of my life. Now,
okay.
So what we've done is to be able to fund this. This includes about 6 greenfield sites built over almost simultaneously over a period of about 5 years. So what we've done is to be able to fund that growth from 12 terminals to where we are now, about 32. In 2021, we now have 34. We built a capital structure from a classic capital structure into what we call internally as a value accretive capital structure. So as early as 2010, we had what we did was from 2007 to 2010. That was during the global financial crisis. So, you know, we were holding back on our reins. We were just watching the market, and over a period of time, we were paying down our bank debt. And by the time we got to 2010, we brought down the number of bank debt to zero, and then we tapped the capital markets. So the function of these acquisitions, of this entire, I would say, evolution of our capital structure is a mix really of small and large acquisitions. Okay, so small acquisitions, including, like what I said earlier, about $12.5 million for Nigeria. The biggest investments that we've made so far is in Mexico. Mexico is probably, including our capex today, is close to about $500 million. We don't get any partners. Most of these we own 100% of. We prefer not to have partners when we go in. We'd rather run everything on our own. Unfortunately,
are these usually bidded out, or it's an unsolicited bid, Joe?
Some are, some aren't. So hence, it's really a mix. Some are M&A, some are privatizations. So hence our cash flow is, you know, so when we talk about EBITDA, we're not consolidating 100% of EBITDA, and yet we only own 51. We own 100% of it, right? And I think that's probably one of the value drivers really of our valuation. Right? So hence, again, we go for small and medium-sized terminals. We've gone as low as 12.5. And we've gone as high as about $500 million.
But then, if you invest 12.5 million, you have to send the Pinoy to go to work in Nigeria,
No,
or you need to find.
Honestly, we barely have any Filipinos actually running any of our terminals abroad. You know, you gotta get locals. You know, they speak the language, they know the culture.
Right.
Yeah. So we used to export Filipinos, but not anymore.
Very good. Learned a lot from your creative capital structure. Well, thank you, Joel. Maybe what I'll do now is I'll shift our last 20 minutes or so. I have a list of questions, and maybe what I'll do is I'll just ask each of you to answer each of them, if you don't mind, so we can get your views. Maybe I'll start with Sir Rob. But the first one is maybe, and you touched a little bit also already in your presentation, Sir Rob, but maybe what suggestions can you give? This one is more for the government and the PSC to encourage more investors to come into the Philippines. At least you've experienced that. Maybe in terms of loosening national restrictions, red tape, other incentives, at least from the eyes of a foreign investor. Sir Rob?
Sure. Look, I think, you know, Joel and Eric may be more sort of closely to make tangible suggestions. And I've also found in my experience hard to make broad brush recommendations, that each sector is different, has its own sort of complexities and nuances. I would say in our experience so far, we've actually found the Philippines government to be extremely efforts. You know, I touched upon the regulatory regime. You know, that's frankly one of the key reasons why we like the Philippines, particularly in the sectors we have so far spent time in. And we have seen kind of broad-based support, you know, for foreign investors. I remember when we had invested in Converge, you know, I personally, you know, met with the DICT, the NTC, you know, Ministry of Finance, PCC, and they were all, you know, very instrumental in helping us kind of build a, call it a positive view of the country. And all along the time period of our investment, you know, we've seen sort of strong support from all quarters. I think you were obviously an integral part of the IPO, and you know, look, I think PSC and SEC in many ways went out of their way to facilitate the IPO, in which at the time, now we are in the new normal, so everything feels, you know, to have capital raising kind of feels are normal. But you know, at the time when we were doing Converge, to get an IPO done amidst all the lockdowns in the country was no small feat. So I think there are always things on the margin, and we've shared some of the feedback live. I think Ed, some of that through you, but like for example, the free float requirement as a percentage threshold as opposed to a dollar threshold, which sometimes may not necessarily work for smaller countries, to make IPOs or capital raising more susceptible to external market cycles. But I think on balance, I found relative to the rest of Southeast Asia, I actually found Philippines to be a little more ahead of some of the other.
Nice.
Yeah. And, I think, and I'm giving you an aggregate picture, right? So I would say there are several things in the Philippines where they have adopted from the best practices, which could actually serve as good example for other countries. And like with all of these things, depending on which subsector you're in and depending on what exactly you're trying to do, there are things that could be done to be better. And as someone who is vested in the success of the Philippines long term, will continue to share that feedback. But I would say overall, we've been quite pleased.
Oh, that's good to hear. Thank you, sir. But at least from a foreign investor, at least who remains positive on the country. Maybe Eric, may I ask you what suggestions you can give at least the GOCCs and the LGUs?
Yeah, in terms of just government regulation, in terms of encouraging more investments, whether it's foreign investments or local investments, which is still a big driver of our investment base. I think the theme of predictability of policy is very important. And again, you can almost apply that to at the national level, specific sectors and so forth. Let me just give one example in the renewable energy space. For instance, government may have all the good intentions. So for example, it's got the way I view policy and effective policy is there are three elements, right? One is there should be a clear goal. In this particular case, the government has stated its energy transition goals, 35% share of renewables, for example, by 2030. Number two is specific policies that will help get to that goal. We already have the mechanisms under the renewable energy law, again, in the case of the energy sector. Where it gets really tough and where we've seen countries like Vietnam execute excellently all the way down to the local government level, and you've seen their renewables shoot through the roof, now over 20,000 megawatts of solar and wind just over the last 3 years. I think that is where there's a lot of points for improvement, the actual execution and enforcement of these policies. And therein lies the uncertainties, the lack of predictability in the Philippines. Yeah. An example would be the reserve market. We've been talking about that for the last 10 years. Until now, there is no reserve market. That's why we are also lacking in reserves. The government has announced the green energy auction of 2,000 megawatts, for example. But we need to know what particular technologies are we talking about, and is it 2,000 megawatts per year, or is it just one time, big time? Because we have to plan ahead of the supply-demand roadmap. No? So we need to take a view. And if we lack the information from the government in terms of how they plan to shape these policies, it's hard for us to make those investment decisions. And in the meantime, we are faced with a tightening power supply, but a lot of uncertainties. So, and then with the lack of reserve market, it just increases the risk profile for the investor. Now, so those are the things that I hope the regulators and policymakers will clarify. They have all the good intentions, but we need to be sharper with execution and address the predictability or lack thereof.
Thanks, Eric. And is it still roughly 180 signatures for a power plant, or that's overstated? It's really that
roughly, Ed, but to me, it's really that's a reality of doing business. It's just an upside. In my book, it's just an upside if we can get those number of signatures down. Don't get me wrong. It's a great thing, but you know what? Power plants can still be done. That to me is a nice to have. The must have really is more of the predictability of policies.
Thank you, Eric. Okay. Joel, you touched about it earlier, but maybe you can expound more on what other things that the government can do and the LGUs.
Yeah, thanks for that, Ed. Actually, I have three things to talk about here. So from a PSE perspective, I don't know them, okay, because I don't really, I'm not involved much on the listing side. But anyway, I think stratify the listing in terms of industry so that you can get actually real industry focus. That's number one. I think there's too much noise in the friction cost when it comes to trading. Intuitively, just taking a look at where PSE was before, where we are now in terms of breadth of products, I think we should change the PSE management. From an FDI perspective, again, I don't know, right? But that's just my personal view. I've not really seen any change. I've not seen any breadth of expansion of products. I've seen them talk about it. Great PowerPoint presentations, but really, it's there. No? On FDI, I talked about developing and promoting industrial estates and linking linking perhaps an economic strategy around these industrial estates. I've forgotten the Supreme Court ruling, if I remember correctly, it's Pandanas, if I'm saying that correctly, and which basically will give LGUs a larger share of the national collection. Correct, of the PIRA. So hence, they should be able to spend much more. They should be developing these industrial estates. The private sector should go with them and basically develop all these. And again, link the economic diplomacy that I was talking about earlier with real domestic strategies and local policies. I also think that when we speak to a counterparty, we have to take a look at them multidimensionally, not just from an import, export, and investment perspective, but perhaps there are other ways by which we can develop a relationship and hopefully convert that to trade in the future. On the energy side, really great points that Eric had put out there. The only thing that I would basically add would be, if there is indeed a gap that we are looking at in the future, why not get the households to participate in there? All right. If you want to be able to drive the price of influence, truly the price of power, get the households to participate. Allow them to trade electricity with each other. As we've seen in many countries around the world, that's been done, and it has truly allowed the redistribution of the cost back to the households, right? So, anyway, these are just my thoughts.
Thank you, Joel. I appreciate those comments, and I hope if there are some of our government officials or regulators there, these were very good suggestions. Maybe you can consider them. I'd like to ask now a question, but turn it around this time. Especially maybe I'll start with Saurabh, because at least you've done it with Converge. But I guess from you, as the three of you are big boys anyway, what suggestions can you give our local corporates, who are aspiring to get either an Ayala or the Razon Group to invest, or Warburg Pincus to invest? What should they do to make themselves more attractive, to prepare themselves for to bring in new investors? Saurabh, maybe can I start with you?
Sure, Ed. Look, I think I can perhaps share some perspectives on what we look for in our investments.
Yes,
and while no one size fits all, perhaps that could serve as a guidepost for what other investors might be looking for as well. I would say there are 3 or 4 things that are quite important to us. One, the strength of the management team. In our view, the business is all about people, and when you partner with good people, they will find good assets and good opportunities, and that's been our experience consistently, time and again. So that's something that's quite important to us. And I always sort of tell people, look, even if you don't have the right people today, it's never too late to bring the best talent. Good people are worth their weight in gold, and something that ultimately, not just for investors, would pay dividends for anyone over time. So that's absolutely key. Second, I would say when we look at businesses, we look at the aggregate market potential and the business model within that market that allows for positive and good sort of unit economics. So typically we are looking at a large addressable market with secular tailwinds that would ultimately drive scale. Philippines, I would say, is a very exciting market, but it has 100 million population. That is going to be what it is. And there are some very positive trends around the rise of the mass affluent, increasing consumption, increasing spending. So to be on the right side of the trends, to kind of build, which allows you to build scale, is something quite important. And then once you sort of pick your sector well and if you're in the right sort of space, make sure the business model ultimately allows for path to profitability. And this is this is one thing we see a lot in tech businesses or digital businesses where lots of clicks and a lot of likes, but ultimately when the rubber meets the road, it's hard to have the unit economics kind of make sense. And it's okay to invest for a period of time and the unit economics to be not positive today, but having a clear, compelling path to profitability is absolutely key, right? So I would say that's number two. Number three, and it doesn't apply all the time, but to the extent there is potential to create market leadership, don't have to be today, but over time, in your aspiration and your ability to get there, that is certainly, we've seen, pays a lot of dividends. Unlike China and India, where markets are extremely large and you could be number 4, number 5 players and get a lot of interest from public markets and investors, in Southeast Asian markets or experiences, if you're not number 1, number 2, then you very quickly fall out of favor. So having that aspiration, having that vision to be kind of a player of scale and number 1, number 2 in the markets or over time, is so set vision high to be able to sort of get there, and we'll provide the capital for you to get there, right? And be there with you alongside every step. And finally, I think it comes to corporate governance, right? And look, I grew up in emerging Asia, and it's not as straightforward and not as robust from a standpoint of meeting the bar of kind of the institutional level corporate governance, but having the key ingredients in place that are right in the context of the market you operate in, and having the systems and processes, certainly in the world that's becoming more ESG, to Eric's point earlier, that the G part of the ESG is increasingly becoming quite important. So I think that's the piece where if you can get it right early on, the better. But again, certainly something we help a lot of our portfolio companies prioritize, and is something important as businesses scale over time. So I would kind of leave with those perspectives as we would look at things. Again, everyone has a different view and different lens at which there's many ways to create value, many ways to make money. Right. But this is something that over the years sort of served us well.
Great. Well, in fact, yeah, I was just going to check. Mike Dinluan, can I just do a time check? Are we supposed to end at 11 or can we extend? Mike? So just
if the panelists are open, we can extend.
No, because what I understand, and Sarah, maybe before I pass the floor back to Eric and to Joel, I know you have an 11 o'clock, Sarah. Maybe if you will allow me, Joel, Eric, I'll just ask Sarah maybe to give your final words or advice to the audience and to the FINEX members, and then I'll proceed with Joel and Eric. Sarah, maybe you want to give closing remarks?
Yeah, thanks, Ed. Appreciate you accommodating me. And look, I think it's been a fantastic discussion. I'm sorry I'll have to cut it short on my end, but really delighted to be in the company of great thinkers in the Philippines. I would say parting words on our side, particularly as it relates to raising capital. One of the things we always tell people who are raising capital is choose your partners wisely. There are a lot of people who can provide capital, but it's important to look for partners who can contribute to your business more than just capital, right? So people who would bring significant value add, and in whatever areas that may be relevant to your business, and people who are willing to kind of work with you and achieve your ambition. So it's it's a very important exercise in get in bed with the right partners and taking your time to figure out, someone who could, be helpful and a true partner to you, be there with you through thick and thin, not just in good times, but also in bad times, is quite important. And look, as I've shared in the presentation and through this dialogue, we are very, very excited about the Philippines. We are hoping to double, triple down, on the country, and would seek opportunities to partner with many more companies. So if there is a desire to have a dialogue with us, I'd be very open. I think the organizer can share my contacts, and would love to hear a story and figure out if something can be done together.
Thank you, Sir Rob. Anyway, it was great to have you. Now, thank you for that. We will share your contact details so that I'm sure many people want to approach you and hopefully happy more investments. Thank you, Sir Rob.
Thank you, everyone. I'll take a leave.
Thank you. Now, let's continue. At least with the generosity of Joel and Eric. Joel, maybe my question is the same. No, it's really more. What advice can you give local corporates so that they will get ICTSI and ASEN to look at them? Or what can they do? But at the same time, maybe I'll ask. I'll segue also to this other question. Is, I guess, aside from what can they do, what experiences or lessons can you share from your actual investments when looking for partners or trying to manage the regulatory, the legal, the frameworks, the financing? That at least advice in general that you can share with audience for corporates looking to invest abroad and looking to get investments.
Yeah,
Eric, maybe I can start with you.
Sure, Ed. I won't repeat. I 100% agree with what Saurabh said in terms of the characteristics or key considerations for a partner. I would just add three things. Number one is integrity. Because
of the partners,
the partners' integrity. Big corporates like Ayala or the Razon Group, for example, would obviously have would give a lot of importance on reputation, and integrity is at the core of these value alignment that needs to be there. So I think that's number one. Number two is, to complement the big corporates who are typically what's lacking in this is probably generalizing. We do have some entrepreneurial people within corporates, but it's few and far between. And I think what we look at with partners, especially the smaller ones, the more agile ones, is this entrepreneurial drive. Especially, for example, in energy, we do work a lot with developers, the smaller ones who don't have the balance sheet, but have the tenacity, the aspiration, the passion to get done no matter what, right? The fire in the belly. So that's quite complementary. I wish we had a lot of those within Ayala Group, but the reality is it's a different DNA. The incentive structures are different, and so forth. So to us, it's being able to work with these kinds of groups or individuals. And number three, the pragmatism in terms and the flexibility in terms of the commercial aspects as well. Of course, a lot of these developers, for example, or entrepreneurs would want to make a lot of money, would be driven by financials and so forth. So it's just to be able to work out a win-win solution for all partners, essentially. So those are the three that I would add. We make a joke that we are also in the business of moderating greed, right? Both of all partners, right? Of the big corporate and the small. Let's see what works for everyone, basically, and it's easier than done. No, but we've applied those elements. We've seen a lot of partners and had a lot of successes, more successes than failures. And we also apply this when we go internationally. Again, I think you'll see a contrasting strategy and approach between an AC Energy and Joel, all right, who would
Joel wants 100%.
Correct. So again, there's no right or wrong answer here. It's worked well for ICTSI. It's also worked well for AC Energy, having a more partner-driven strategy, for example, where again, all of these elements we discussed are quite important for us because it helps us become successful in these other markets.
Thank you, Eric. Joel, what words of advice can you share our audience?
No, great insights actually coming from Eric and Saurabh. So, and I echo all of them. So, we just look at it four things. No, assuming that the business model and returns are fine, there are really four things that we look at: people, scale, focus, and capital structure. So, people, we talked about integrity, talked about level of skill, et al. So that's given. Second is the ability to scale up the business.
So not
look,
me. Okay, as long as there's a way also. Okay.
Correct. So think about this. When MICT was acquired by ICTSI in 1988, throughput then was just slightly north of 200,000 TEUs. 33 years hence, we're now close to about 2.5 million TEUs. Right. So hence volume value accretion had really risen geometrically over the period. So hence scale is extremely important to us. And finally, just in terms of the last one would be capital structure, i.e., will it have the opportunity for us to be able to, by putting in capital, can we actually extract it with the same ease at which we had put it in? So there are certain countries which to us we could never cross simply because of the inability to be able to pull out our capital. So those we look at very, very closely, not just from the perspective of jurisdictions, but similarly in terms of what the CapEx plan looks like over X period of time. Right? So those are really the four things that we've narrowed it down to.
It's really a science for you already. Anyway, and as you said, the best 12 years of your life you gave to building ICTSI.
14.
14, okay. And besides, you guys don't retire anyway, so you'll have another 20 years there. So anyway, I guess we're at the close already. So if I may request again, maybe Eric first and Joel, maybe just your last words of advice for the audience, and then I'll pass the floor back to Carlo.
Yeah, Ed, thanks a lot for this great panel, the opportunity to share our insights. Now, I think we live in very interesting times, to say the least. I think there's a lot of challenges, but there's also hope. One of the silver linings of the pandemic really is the wake-up call on the global issues such as sustainability. So I think, as I mentioned earlier, ESG has been a very powerful force. It's taken a much more a higher level of importance and urgency, especially amidst this pandemic. So I think this is something that will be a must. I think not everyone has embraced this yet, and this is an opportunity and really a wake-up call for all of the companies to embrace and to be clear with what their point of view and what their strategies and goals are with respect to environment, social, and governance matters. There's a lot of opportunities. We see that in the energy transition. We see that in the investment world, the capital markets, financial markets. I think it is an opportune time for us to really be proactive and shape the next 10, 20 years will be shaped by our ability to commit and demonstrate performance on ESG. A plug, Ed, is I will be happy to share more of these insights. I think there is another FINEX conference in November. I had to make sure with Baby that I'm not confusing this with the other one where I will be keynote. I would be more than happy to share again the experience and insights on sustainability and ESG as a value creation driver for the company. But I think this is more than just a cliche. We have to live it and really commit to that new reality.
Thank you, Eric. More power to you. Literally and figuratively.
Thank you.
Okay, now Joel, more tonnage to you, more TEU to you, Joel. Go ahead.
Thanks for that, Ed. It's really been a great panel, and very honored really to be amongst these among the entire panel. Really, it's been a fantastic morning. I'm going to wax a bit philosophical here. Okay, I know we've been talking about the practical side of things, strategy et al. Over the past 4 or 5 months, I've been in touch really with quite a number of entrepreneurs, because I myself, I'm a hobbyist tech founder.
I know, yeah, you have hotels and resorts.
Yeah, and many of them have actually asked us, or have asked me, how they should be looking at the future, on whether whether they should pull the reins in respect to the pandemic et al. And this is basically what I tell them. So, in ICTZI, I've basically gone through 3 cycles, right? Once you focus on your cycle, on your particular industry, and once you have your vision in terms of your growth, all these that we're experiencing right now are really bumps on the road. Okay, and taking it a step forward, just in terms of what they can truly achieve as entrepreneurs. And this is where I become actually a little bit philosophical. And I tell them, I take the words of this gentleman named Dr. John DeMartini. I don't know if you guys have come across him. And he had this to say: many people say there are immortal souls, but very few ever write immortal goals.
Mm-hmm.
This is an opportunity for entrepreneurs to begin writing their immortal goals and pursuing them. Morning, everyone.
Thank you. So that's destiny for all of us. We had 3 great speakers with Saurabh, Joel, and Eric. Ladies and gentlemen, that is this morning's session. And thank you again for attending. And I pass the floor back to Carlo. Carlo, thank you.
We would like to thank our keynote speaker, Mr. Agarwal, our panelists, Mr. Consing and Mr. Francia, and of course our moderator, Mr. Francisco, for an in-depth and very insightful panel discussion. We would like to also thank our sponsors for this year's conference, our partners, Divina Law, LT Group of Companies, and Union Bank of the Philippines. Our platinum sponsors, Aboitiz Equity Ventures, Alliance Global Group Inc., First Philippine Holdings Corporation, NOAA Business Applications, Robinson's Land Corporation, United Auctioneers Inc., and Vista Land and Lifescapes Inc. Our diamond sponsors, All Day Supermarket, All Home, Ayala Land Inc., Meralco, and Reyes Takandong and Company. Our knowledge partner, KPMG RG Nabat and Company, Artec Holdings Philippines Corporation, Converge ICT Solutions Inc., Navarro Ampere and Company, Deloitte Philippines, FTI Consulting Inc., Metrobank, Mondenisian Corporation, PNA Grant Thornton, RCBC, San Miguel Corporation, Filipina Shell Petroleum Corporation, SGV and Company, and Philinvest Development Corporation. And our patron sponsors, BDO Unibank Inc., Mega World, Philippine National Bank, Security Bank, Wilcon Depot, and East West Bank. And our official broadcast partner, ABS-CBN News Channel. And lastly, our print media partners, Business Mirror, Business World, The Manila Times, and Daily Tribune. Once again, we'd like to thank everyone for attending today's session of the FINEX Week Conference. We hope that you will continue to join and participate in the rest of our webinars this week. Thank you, everyone. Keep safe and have a great day.
Thank you, Carlo. Thank you, Eric. Thank you, Joel.
Thanks. Thank you.
Thank you. Mike, there might
Everyone.
have been some questions. Just note about everybody questions. Mike.
Hello, Ed. Hello. Good session.